Welcome to the DX Today podcast, your daily deep dive into the AI ecosystem. I'm Chris, and joining me as always is Laura.
Hey, Chris, great to be back in the studio with you. And honestly, today is one of those episodes where I had to clear my whiteboard twice because the story kept getting bigger every time I looked at it.
That is the perfect setup because what we are unpacking today is the kind of announcement that does not just move a stock price for an afternoon. It actually rewrites a chapter of the playbook.
Exactly right. So the headline, for anyone who hasn't seen it yet, is that Anthropic just shipped 10 purpose-built AI agents aimed squarely at banks, insurers, asset managers, and the broader financial services industry.
10 agents in one drop is already a lot. But the part that made me sit up was the staging of the announcement itself, which felt deliberately choreographed to send a much bigger message.
Oh, totally. The launch event was in New York on May 5th. And the moment that everyone is talking about is the first ever shared stage appearance of Dimon and Amodei from Anthropic and Jamie Dimon from JP Chase.
Just to put a fine point on that, Jamie Dimon does not stand on stage with random vendors. When he shares a stage with a model lab CEO, that is a positioning statement aimed at every bank board in the country.
Right, and the symbolism only gets stronger when you stack the rest of the announcements on top. Anthropic also revealed a joint venture with Blackstone, Hellman and Friedman, and Goldman Sachs anchoring it.
Walk me through the financial structure of that joint venture, because the numbers I saw being reported are pretty stunning for what is essentially a vertical specific deployment vehicle, not a model training run.
Sure. Each of the three anchor investors, Blackstone, Hellman and Friedman, and Goldman, is expected to put in roughly $300 million, with Goldman Sachs specifically anchoring around 150 of that.
And that is just the anchor tier. Who else is on the cap table for this thing? Because the supporting cast is also a who's who of capital allocators in the global financial system.
Beyond the anchors, you have General Atlantic, Leonard Green, Apollo Global Management, GS, which is the Singapore Sovereign Wealth Fund, and Sequoia Capital all participating, with the total commitment expected to land near $1.5 billion.
$1.5 billion for a financial services-specific AI services company. That is not a science experiment. That is somebody saying, we believe agents in finance are about to be a real durable revenue line.
And remember the framing here. This is being positioned as an enterprise AI services company, which means custom deployments, professional services, integration work, the kind of high-touch motion that a Goldman or a Blackstone instinctively understands and values.
Okay, let's actually pop the hood on the 10 agents themselves, because I think the names alone tell you a lot about who Anthropic talked to before they shipped this. What is in the lineup?
The 10 cover a really clean set of finance workflows. You have the pitch builder, meeting preparer, earnings reviewer, model builder, market researcher, KYC screener, valuation reviewer, general ledger reconciler, month-end closer, and statement auditor.
That list is basically a tour of the most painful Sunday night work that happens inside an investment bank, an insurer, or an asset manager. Each one of those agents replaces a specific late-night spreadsheet ritual.
That's a great way to frame it. Take the general ledger reconciler. That agent reconciles ledger accounts and even runs net asset value calculations, which is some of the most thankless and most consequential work in fund operations.
Or the month-end closer, which apparently runs the close checklist and prepares journal entries. Anyone who has ever worked in a controllership team is hearing that and pricing in their next vacation right this minute.
And the KYC screener is interesting too, because it doesn't just classify a single document. It assembles full entity files and reviews source documents for compliance, which is exactly the messy multi-step work that humans hate.
What I really like about the pitch builder and meeting preparer pair is that those are the analyst and associate killer workflows on the front office side, while the back office gets the close audit and reconciliation agents.
Right, so Anthropic is hitting both ends of the bank at once, which is structurally different from what we have seen from competitors who tend to specialize in either deal flow tools or back office automation, but rarely both.
So how do these things actually run in practice? Because there's a meaningful difference between an agent that lives inside a chat window and one that runs autonomously across a whole multi-day process unattended.
Anthropic is offering 2 clean deployment modes. You can run them as plugins inside Claude Cowork or Claude Code, sitting right alongside the human analyst, or as Claude-managed agents running autonomously on the Claude platform.
That dual mode is smart because it lets a regulated firm dip its toe in. You can start with a co-pilot pattern in front of a human reviewer and then graduate the same agent to fully managed once the controls are proven.
And on the integration side, they finally landed the Microsoft 365 story properly. Claude now ships as native add-ins inside Excel, PowerPoint, and Word, with Outlook coming soon, which closes a real gap.
That Excel piece in particular is so much bigger than people give it credit for, because the spreadsheet is still the universal interface for finance. And any agent that cannot live inside Excel is not getting adopted on the floor.
100%. And that is one place where this announcement directly threatens incumbent vendors, because the spreadsheet was the moat for a lot of the old data and analytics players, and now Claude just walks through the front door.
Speaking of incumbents, the data connector list they unveiled is genuinely intimidating if you sell financial data for a living. Walk me through who is now plumbed directly into the agents on day one.
The data partners include Dun & Bradstreet, Fiscal AI, Financial Modeling Prep, GuidePoint, IBIS World, SS&C Intralinks, Third Bridge, and Verisk. And then on top of that, Moody's launched a separate app of its own.
And the Moody's app is not a small thing. They are giving Claude users direct access to credit ratings and data covering more than 600 million public and private companies through a first-party Claude integration.
That coverage number is wild when you say it out loud. 600 million entities flowing through a model that can also reason about a pitch book, a KYC file, or a valuation memo at the same time.
This is also where the FactSet reaction makes complete sense. FactSet shares dropped about 8% on the news, and that is the market literally pricing in disintermediation risk for a category-defining data terminal vendor.
It is, and FactSet may not be the only one. Any vendor whose core value is being a structured data and workflow layer between the analyst and the underlying data should be reading this as an existential signal, not a one-day blip.
Let's zoom out on Anthropic's overall enterprise footprint, because I think people underestimate how far along the company is in the financial services land grab even before this announcement actually dropped on May 5th.
The numbers are pretty striking. Anthropic now reports more than 300,000 enterprise customers, and roughly 40% of its top 50 clients sit inside the financial services sector, which is wildly concentrated.
That is essentially a finance-shaped company at this point. And remember, Claude for financial services as a product line first launched back in July of 2025, so this is the second big chapter in that strategy.
Right, the predecessor was the foundation. This release is where they go from a horizontal model with finance polish to actually being a finance vertical software company that happens to be powered by their own frontier model.
One thing I want to push on, though, is the trust question. Putting a model into KYC and statement audit work means the regulator is now in the room with you, whether you invited them or not.
That is a huge question, and Anthropic has clearly been gearing up for it. The fact that they led with use cases like reconciliation, month-end close, and statement audit, which are deeply controlled workflows, is not an accident.
Right, those are workflows where the firm already has detailed control frameworks, sign-off chains, and audit trails. So dropping an agent into the existing control plane is much easier than inventing brand new oversight from scratch.
And the fact that Jamie Dimon was willing to stand next to Dario Amodei publicly tells me that JP Morgan is comfortable with the controls and the data handling story, because that man does not do photo ops casually.
Let's talk about the broader competitive read on this. OpenAI has been making its own enterprise push, and the framing in a lot of the coverage is basically Anthropic and OpenAI now racing for IPO-ready revenue.
That is exactly the dynamic. Both companies are trying to convert science demos into recurring enterprise contracts. And finance is the perfect proving ground because the buyers have huge budgets, deep pain points, and very few good incumbent agent products.
It is also a story about distribution. Microsoft has a massive Office franchise and a deep banking relationship through their existing tooling. So the fact that Anthropic landed Excel, PowerPoint, and Word native integration is a distribution coup.
And Claude Cowork showing up here matters too, because that is the desktop-style consumer-feeling product that lets a non-developer analyst actually use these agents without needing it to build a custom app for them.
Which brings us to the human side. If I am a junior analyst at a bank tomorrow morning, do I look at this lineup and feel excited because the boring work is going away, or scared because my job description is the boring work?
Honestly, both. The historical pattern with this kind of automation is that the most repetitive parts of the analyst's day get compressed first, and the people who survive are the ones who become really good at orchestrating the agents.
That tracks with what we have seen in other industries. The job does not disappear, but the value add shifts from doing the work yourself to designing, supervising, and quality checking the work that the agents are doing for you.
Exactly. And inside a regulated bank, that supervision layer is going to be extremely valuable because somebody still has to sign the audit trail and own the answer when the regulator picks up the phone next quarter.
Last big question for me. Where does this go from here? Because shipping 10 agents and lining up Goldman, JP Morgan, Visa, Citi, and AIG as customers is impressive, but the next 12 months is where the strategy gets tested.
My read is that the next move is verticalization on top of the verticalization. So you will see specialized agents for insurance underwriting, ratings analytics, derivatives operations, and probably a much deeper push into private credit workflows.
That makes sense, especially with private equity firms like Blackstone and Hellman and Friedman literally on the cap table of the joint venture. Their portfolio companies are an obvious test bed and an obvious distribution channel for the next wave.
And do not sleep on the international piece either. Singapore's GIC being part of the financing tells you Anthropic is thinking about Asia banking too, where the regulatory and language complexity actually plays to a frontier model's strengths.
So if you had to summarize the whole story in one line for a CFO who has not been following this space, how would you put what just happened on May 5th into a single concrete takeaway?
I would say this. Anthropic just stopped being a model vendor and became an operating layer for Wall Street. With 10 ready-to-run agents, deep Microsoft integration, premium data partners, and $1.5 billion of conviction behind it.
That is a great summary, and I think it really captures the shift. We have moved from the era of demos and pilots to the era of named workflows, named partners, and budget line items inside the world's biggest banks.
And as always, the next thing to watch is the second derivative. Which incumbents adapt, which ones get disintermediated, and which non-finance verticals get the same 10-agent treatment from Anthropic over the next 2 to 3 quarters.
That is a perfect place to land it for today, and I think anyone listening should keep one eye on the next earnings cycle to see how these agents start showing up in management commentary across the big banks.
Agreed. And if you only remember one number from this whole episode, remember that $1.5 billion joint venture, because that is the clearest signal yet that finance has decided agents are real spending, not pilots.
That's all for today's episode of the DX Today podcast. We'll keep tracking how Anthropic, OpenAI, and the rest of this market evolve. So thanks for listening, and we'll see you next time.